Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Financial Management, and the course code for this subject is twofold. As per Curriculum 2016, its code is MS251, and according to the new Curriculum 2018, the course code for this subject is BS251 with same contents. This is our lecture number 16, and the topic for today's discussion is common stock valuation under the case of zero growth assumption and growth phases when we got two different phases. Basically, this lecture is in continuity to my previous lectures, and I strongly urge to the listener of this lecture to first listen to the previous couple of 2 or 3 lectures, because those will assist you to understand the basic concept and idea for valuation of common stock under zero growth and growth phases. Hence, the outline of this lecture comprises of 2 main agenda points. Number first is to value the common stock with the second assumption named as zero growth assumption, when we assume that the stock is not growing, rather a fixed stated or a constant rate of dividend is paid out by a particular company. And secondly, valuation of common stock with different growth phases. So these two agenda shall be discussed shortly in this lecture with the help of relevant examples. So let's discuss the first model named as zero growth model or zero growth assumption. As name states itself that under this scenario, zero growth model assume that the dividends of the corporation or company will grow forever at the rate of G is equal to 0. It means that we can change this assumption or narration like the zero growth model assumes that the dividend of the companies will not grow at all. It means that the factor G is equal to 0 or it is constant. So the value of zero growth common stock is equal to divide or discount the first time period's dividend, the second time period dividends, and then so on and so forth up to infinity dividend, because this stock is going to pay you dividend at a fixed stated rate or fixed denomination in terms of dollars, and all the dividends shall be discounted back to time 0 in order to find out its value, which is quite difficult as we cannot discount all the values up to infinity. Therefore, the reduced form of valuing such kind of common stock is to divide D1 by KE, which is the discount rate. Here D1 is the dividend paid at time 1, and this value is at time 0 because we are interested to find out the value at time 0. Therefore, we have to make certain calculation in order to get D1. Similarly, the KE is the investor's required rate of return, and for more details regarding the cost of capital and investors required rate of return, my next upcoming lectures will discuss them in detail. So let's take an example of a zero growth model, that how to calculate its value. The question or narration states that we got a stock named as zero growth, Z and G, has an expected growth rate of 0%. Hence, the G factor in this case is 0. And as we knew that the constant growth model formula was to divide D1 by KE minus G. KE minus G. So when the G factor is 0, the simplest leftover formula is to divide D1 by KE. Each share of stock just received an annual dividend of $3.24, and the statement states that this dividend has been received at current time 0. The appropriate discount is also given, which is 15%. In this case, it is the value of KE. However, this 3.24 is not D1, rather it is D0. And we knew that in order to calculate D1, we have to multiply the D0 with 1 plus the growth factor, which is G. In this case, let me write down the formula for calculating D1. And as we knew that the G factor is 0, so therefore 1 plus 0 is equal to 1. And if 1 is multiplied by with any factor, it will remain as it is. So therefore D1 will remain the same value for D0 in zero growth model. Question asks you to calculate the value of this common stock. So it's very simple. We have to calculate the D1. As mentioned, it is as it is because the G factor is 0. So therefore, it does not have any influence on D0. Therefore, we can say that D0 and D1, D2, D3, and so on and so forth will be carbon copy or same amount as D0 because the G factor in this case is 0. So therefore, there will be no difference on D1, D2, D3, so on and so forth under the case and assumption of zero growth model. So finally, now we are in a position to calculate the value of this common stock by plugging this D1 into the same formula, D1 divided by KE minus G, as G is 0. So therefore, the leftover amount will be D1 divided by KE, and KE in this case is 15% as we have plugged in this value into the formula, and we come up with $21.60, the intrinsic value of this zero growth model or zero growth common stock. The decision will be to invest in this stock if somebody is selling on $21.60, and if somebody is going to sell out this stock at a price in excess to its intrinsic value, then it is not worthwhile for the investor to invest their money in. Now let's discuss the final assumption, which is growth phase model. It is a little bit complex and needs your concentration to understand this model in order to find out the intrinsic value or under growth phase model. So the growth phase model as states that it has 2 or 3 different phases, and we have to discount back those dividend according to different phases. It assumes that dividend for each share will grow at 2 or more different growth rates. So therefore, the formula, like in our case, we got, or we'll see shortly, an example related with a common stock having 2 different phases to grow its dividend. The formula for calculating the value of such common stock is to discount the initial time period or phase value up to time t, where the growth rate will subsequently be changed. Like in this case, it's mentioned t over here. And then from time t up to infinity, the common stock will grow at a different growth rate, which is G2. For more detail and understanding, let's take an example to understand in the subsequent slides. So we have to note that the second phase of growth phase model assume that the dividend will grow at a constant rate of G2 forever. So we can write this formula in the fashion like this. Initial notation is quite similar to the mixed stream question or mixed streams. For example, we got 1, 2, or 3 different cash inflows in the subsequent time periods up to time t. Therefore, we can individually discount each cash inflow with the relevant discount rate to get the present value or intrinsic value of that common share or project. So I assume that you have the enough knowledge of time value of money concepts. If not, you can go back to my channel and you can find out lectures on time value of money where I have explained the mixed stream questions in detail. That is how to calculate the present value if we have different cash inflows over the period of time. However, the second section of the previous formula looks like this, or we can write down in this fashion. This 1 divided by 1 plus ke raised to the power n is the present value factor, which shall be applied on the second section of the formula, because the second section states that the dividend after G2 will grow at a fixed rate. Let's suppose if it is 8%. So the question will state that the dividend will grow forever at the rate of 8%. Therefore, we can apply our first assumption formula, which states that the dividend is growing at a constant rate forever. So this formula is quite synonymous to our first assumption, what we have discussed in the previous lecture. Here comes an example of growth phase model, which will further elaborate how to do or how to value such common shares. So stock GB, as mentioned before, named as growth phase, has an expected growth rate of 16%. So initially the G1 is 16% for first 3 years, and then the growth of this share will subsequently change to 8% thereafter forever. So G1 is 16% and G2 is 8%. And then the question states each share of stock just received an annual dividend of $3.24, which is D0 in this case. The appropriate discount remains same as in the previous example. However, we got two different growth rates in this case, and the question asks you to calculate the value for this common stock. So let's mention first of all the different dividend rates over the timeline, so that to understand what kind of growth factor is applicable for what number of time periods. So timeline starts with time 0, which is just time periods or today's time period. And the question states that the dividend will grow at the rate of 16% for the next 3 years, and D0 was 3.24. So it will grow at the rate of 16% for the next 3 years up to third time period, where the third time period will end. And hereafter, when the fourth time period will start, the same company common stock will grow at the rate of 8%. For how long? For up to infinity. So let's see. We can divide this timeline in two different phases, like in this fashion. Timeline start from 0 up to time period third, where the dividend is supposed to grow at the rate of 16%. We can say that this timeline is quite similar to the mixed stream, where we will discount the different D1, D2 and D3 with the given discount rate. However, the second section of the timeline states that the dividend will grow at the rate of 8% at the start of fourth time period, or we can say at the end of third time period, the same company's common stock will grow at the rate of 8% up to infinity. So we can apply the constant growth model on this second section of the timeline, because the conditions are quite similar to the constant growth model mechanism. However, in the first time period, or I can say the first timeline, we have to apply the mixed stream discounting mechanism. So first of all, let's select the second timeline to calculate the value of this common stock up to the time period third, or we can say at the end of time period 3, we have to find out a particular value named as value 3, as mentioned in this formula. So what is the requirement for calculating V3 or the intrinsic value of this stock at time 3? The formula is to divide, not to divide D1. Remember, we are going to discount back this different dividends under the condition of constant growth model at time 3. So therefore, in this case, when the value is subscript with 3, we have to select the next year's dividend, and the next year dividend is termed as D4. So therefore, D4 divided by the required rate of return KE minus G. This formula will help us to discount or to use the constant growth model mechanism to find out the value of this stock at time 3, which will further be discounted back towards time 0 in order to find out the complete value of this common stock. So it's now very easy. We got a new timeline as mentioned over here, and the formula for calculating the value at time 3 is D4 divided by KE minus G. So now we only need to find out the first 4 dividend which are important. D0 is 3.24 as mentioned in the question. However, we have to find out D1, D2, D3 and then D4 in order to find out the total intrinsic value for this common stock under 2 growth phases of 16% and 8% subsequently. So let's do it. D0 was $3.24 as mentioned in the question. In order to calculate D1, we have to use this formula, D0 multiply by 1 plus G1 raised to the power 1. Therefore, the value for D1 is 3.76. It means that the current dividend of $3.24 will grow at the rate of 16%. Therefore, the next year dividend will be $3.76. For calculating D2, we have to repeat the same formula, but this time the power will be 2 because it is far away 2 time period from D0. Plugging the values, and D2 is $4.36. Similarly done for D3, a similar mechanism has been adopted. That is D3 is equal to D0 1 plus G1 raised to the power 3 because this D3 is 3 period apart from D0. The final value for D3 after simple mathematical calculation is $5.06. And finally, the requirement for formula was to find out D4. So in order to calculate D4, as we knew that the dividend was growing at the rate of 16% for the first 3 time period, and then for the subsequent year it will grow at the rate of 8%. So therefore we have to change slightly our formula to calculate D4. D4 is equal to D3, which is 5.06 because we are at the end of 3rd time period, and this dividend will grow now at the rate of 8% rather than 16%. So therefore we have to apply 8% factor in order to come up with D4 value. This is the reason we have mentioned D3 with multiplicative factor of 1 plus G2. We have to change over here the second phase of our growth rate, which is 8% given in the question. And the power is this time 1 because this D4 is only 1 period apart or far away from D3. Hence, the D4 after simple mathematical calculation is 5.46, and now we are in a position to plug these values into the relevant formulas in order to find out the intrinsic value under this scenario. Let's do it. So we have mentioned that the dividend D naught at time 0 was 3.24, and it has grown at the rate of 16% for the next 3 years. Therefore, the next time period D1 is 3.76. The second time period, which is D2, is 4.36. And similarly, it has further grown at the rate of 16%, and it leads towards $5.06. We have mentioned the relevant values on the timeline. However, the formula states to calculate V3 with the help of constant growth model was to divide D4 by KE minus G. So KE minus G in this case is as mentioned below. D4 is 5.46 as we have calculated in our previous slide. The discount rate is 15% and G2 is 8%. So we have plugged the relevant data into the formula, and the value at time 3 is $78 for this common stock. However, the question is not complete because we have to discount it back towards time 0 in order to find out its today's intrinsic value. Along with that, we have to discount these 3 dividend as well with the help and the same mechanism as we have done in the present value for mixed streams. How to do that? We have 2-for-2 mechanism, either to use the formula for calculating the present value for each similar or resembling type of mixed stream question, or another way around, we can also use the present value interest factor table, which is quite simpler and easier than formula mechanism. Therefore, we have opted for table method, and let's do discount 4 values which are mentioned over here as D1, D2, D3, and along with that this value at time 3 towards timeline 0 in order to find out the final intrinsic value of this common stock under 2 different growth phases. So the first present value for D1 is to discount D1 by taking out the relevant factor, which is present value interest factor at the rate of 15% for one time period, and the factor in this table is 0.87, and by multiplying this value with D1 we got the first present value for D1. This is our first present value, and we have discounted it back towards time 0. T is equal to 0, and we are discounting each value towards time 0 in order to find out the today's intrinsic value. Then we have done the same formula and procedures for discounting D2 this time. We have to go towards the present value interest factor table, where we have to look for 15% discount rate. In row number 2, the factor is 0.756, and the next present value for D2 is 3.30 under the discount rate of 15%. Similarly, for D3, we have to adopt the same mechanism. Only the factor will change and D3 value will change. Plugging the D3 value, which is 5.06, and multiplying it with the present value interest factor at the rate of 15% for 3 number of time period is 0.658. By multiplying both these values, the third present value is $3.33. We have discounted the first 3 dividends. However, only one amount is left over, which is known as the value 3, what we have discounted with the help of constant growth model, and the value of this stock at V3 was $78. Therefore, we have to discount it back towards time 3. Present value P3 is equal to P3, the price of this stock, which was $78 at the end of third time period. And the same factor shall be used to discount this value towards timeline 0. The same factor will be plugged into this position. Multiply this value 3 with the present value interest factor at the rate of 15% for 3 number of time period, and therefore the value of this stock at time 0 is $51.32. Now we are in a position to find out our total intrinsic value for this common stock under two different growth phases, because we have discounted all the values with the help of formula or with the help of present value interest factor table. In this case, the final step is to sum up these four values starting with P1, P2, P3, PV3, and then this final discounted value will lead towards the conclusive intrinsic value of this common stock. And here it is. Finally, we are going to calculate the intrinsic value by summing all of the cash flow present values. We have discounted D1 towards 3.27, D2 towards 3.30, D3 towards 3.33, and finally the value 3, which was $78 previously at time 3, is discounted back towards time 0, and its value is 51. By summing all of the cash flows present values, we got the conclusive intrinsic value for this common stock under two different phases, which is $61.22. So now it's time to take the decision by the investor. If someone is selling out this common stock at a price equal to 61.22 or nearby, the investor will probably go for investing their precious money into this common stock. However, if the corporation or the shareholder already owning this stock is looking to sell out this share at a price in excess to $61.22, let's suppose he or she is offering this stock at a price of $65, then the investor must not invest their money into this stock, because according to the mathematical calculation, it is overpriced. Here it is, the final formula what we have written at the start, like time value of this growth phase model, where the time 1 starts from where the time starts from 1 towards 3, and we have used the summation sign to sum up this mixed stream type of 3 dividends, and then we have discounted our final value, which was $78 at time 3, by multiplying this discounting factor. Either we have to use the present value interest factor table, or we can use this direct formula to find out the intrinsic value, which is $61.22 for this common stock under two different growth phases. So I hope that you now understood the three different assumptions for calculating or finding the value of common stock under constant growth assumption, under zero growth, and as well as under different growth phases. Thank you very much for listening to this lecture. If you have any confusion or question, feel free to post your queries on KCMS, or another way around, you can also email me your question at my official email address as mentioned in the footer of this lecture. You can also put your comment on this video so that I can answer your queries. Good luck for the day. Allah Hafiz.